I'm not coming out. I don't care if the camera's on. I'm not coming out. Just kidding. Okay, welcome to Random Rogers Big Picture for the week of, March 3rd already. How about that? This week I wanted to talk about what else? The market and what a crazy week it was. A couple of things. Friday afternoon, I was at the gym, and in between gasps for air on the Treadmaster, or the Stairmaster, I heard Gary B. Smith say something about, this kind of looks like we might be having a crash. And that was interesting to me. Here's kind of what I wanted to talk about with regard to a crash, and then I'll talk a little bit about the current environment. To be crystal clear, because I know someone's going to add 1 and 1 and get 11 on this, I am not predicting a crash. I have no idea about such things, and I'm not even worried about trying to predict a crash. The thing that's important, if you're managing your own portfolio, is not predicting a crash, but having a game plan for a crash if it happens. And I do. I've had kind of the same game plan for a while, but I kind of crystallized it a little bit, spoke with the gal at work who helps with the trading, and so we've got a very simple plan of action that'll just involve 2 or 3 trades. And it's important to know right now I've got absolutely no emotion. I don't know if I would have any emotion if there were to be a crash, but got a game plan all spelled out. Now, one thing I kind of wanted to look at, and I've got it here on the new laptop. Hey. Take a look at the historical price for October of '87. The crash, as you may or may not know, looks like it occurred on October 19th. It closed on Friday at 282, the S&P 500, and then closed Monday the 19th at 224. So I guess that's 58 points of a drop. It had been falling for quite a ways before then, a lot more than the 3 or 4% that we fell this week. Back at the beginning of the month, it looks like the high close was October 5th of '87 at 328. So it had already fallen a whole lot before. I mean, think about that, 328 to 282. That's an awful long way. It had fallen a lot. The day before the crash, it had fallen 7 points, 6 S&P points, which is in the neighborhood of 3%. Better make it 2%. So I don't know that we necessarily can draw a parallel, but the one similarity, and probably the only one, is that the crash did not come from a high. The market right now is not at its high. It's 3 or 4% off of its high. Back then the market was much lower. So having a game plan, make it now, make it over the weekend, something that you specifically would do if you're inclined to do anything at all. And for some folks, it's really, they shouldn't do anything at all. The other thing is, if there is a crash, not to let yourself succumb to emotion and panic into anything. A crash, they've happened before. I have no idea if a crash is going to come, but at some point in your lifetime, there will be another crash. And it will be a whole lot like the other crashes that have occurred in history. Right now, whether a crash is coming or not, we're going down a V like that. The other side of a V is like that. So if you make no changes whatsoever, in all likelihood, selling into a crash is selling into the bottom, which is the wrong thing to do. Even in 1987, it took a couple of years to make its way back, but the low occurred within like a week or so of the crash. It looks like, it hovered right around that. Well, I don't see a lower print than 224s, but it's possible that the low did come, sometime in November maybe. Either way, the point is, once that happens, selling down here at the V is the wrong place to sell. So have a game plan now. One other thing I wanted to talk about is what is going on in the markets. Now, I don't know what the magnitude of the consequence is. That's not going to be solved here. But what's causing this, in my opinion, from 60,000 feet or the big macro, is liquidity issues, or the threat to liquidity. I saw a good chunk, God help me, of the Kudlow show Friday afternoon, and he laid out all sorts of things why, things are just hunky-dory. Aside from, quite candidly, not trusting his the way he selectively picks data to talk about. And that's true. I flat out don't trust the information I get from him as being too one-sided. But nothing now says recession. They talked about on the show, I think Leisman brought this up, PE ratios of the market look good, just all sorts of various indicators that look healthy. And so no recession. Yeah, we're not in a recession right now. The stock market, as you probably have heard, is a forward-looking indicator. Maybe it's forward-looking by 6 months, or maybe it's 12 or 9 or some other figure. But the stock market looks forward. The market is not going to anticipate a recession that's going to start next week. It's looking ahead. If you look back at history, the market rolls over, and it does it slower than what we've done this week, but the market rolls over slowly out way in front of when the economy actually goes into a recession. So, coincident data is not going to reveal a recession, and I'm surprised Larry doesn't know that, but whatever. But things that threaten liquidity, the carry trade is not the end of the world. It's just one small threat. This business with subprime, I don't know how important it is or isn't. And again, it's not the default rate that I don't think is the potential problem. It's the future constriction of credit, or not allowing more people access to credit. This has been a credit-driven, liquidity-driven market. And if that starts to be impeded in any way, that is the threat, not some sort of increased default rate. Even if the default rate doubles, it's not going to have a significant impact. It's the threat of constriction of future credit. That's the thing. Have a game plan for a crash, even if one never happens, then you're no worse off. But make the game plan now while you have your wits about you. Have a great weekend.